Dear students, welcome to lecture 4 of week 12 wherein we have been discussing about export risk and insurance. Today we are going to discuss a very important topic, that is ECGC, its role and coverage. Let us begin the journey. At the outset, let us go through the contents of today's discussion, what all we are going to discuss in today's discussion. We are going to initially start with the introduction to ECGC, followed by establishment and objectives. After that, we will be focusing on functions and scope of operations, followed by risk covered, both commercial and political. After that, we will try to understand the policies for exporters related to ECGC as well as financial guarantees to banks. Subsequently, we will try to dig deep into buyer's credit and insurance as well as credit rating and claim process. After that, we will try to understand country risk classification, followed by ECGC's role in export credit ecosystem. The penultimate discussion will be about relevance in modern trade context, after which we will conclude our discussion. At the very outset, it is important for all of us as the students of export-import to understand and appreciate that exports always invites different types of risks. Thus, exporters face different types of risks such as commercial, political, financial, which may result in losses and non-payment of the revenue. We all know, and we have been discussing over the course of this content, that there is always a need to understand the risks that are associated with exporters' operations. These may come in different forms, but one of the direct influencing form is non-realization of the payment. This non-realization may be because of some political factors, maybe because of some economic factors, maybe because of some commercial factors. Apart from this, another important point to be associated with this, that to promote Indian exports, the government has established, in line with the understanding of risk associated with exporters, the Export Credit Guarantee Corporation of India Limited. This is where the government is trying to understand and trying to minimize or mitigate the non-realization risks that are emerging because of political factors, commercial factors, or economic factors. In addition to this, when we say that Government of India has formed this Export Credit Guarantee Corporation of India Limited, why it has been formed needs to be understood. Thus, ECGC provides credit insurance and guarantees to protect exporters and also the associated banks and financial institutions against the losses that may arise during the course of export. This organization, that is Export Credit Guarantee Corporation of India Limited, is acting as India's main or principal institution for export credit protection as well as trade promotion. Let us now talk about its establishment and its ownership. It was founded in 1957 as Export Risk Insurance Corporation, but it was renamed as ECGC Limited in 1964. Obviously, with the changing times and dynamics of the international economic environment, it was necessary to transform organization's outlook into a full-fledged limited company having an independent ownership. This is wholly owned by Government of India wherein the administrative control lies with Ministry of Commerce and Industry. Thus, this is a public institution working in India, and it is committed to the objectives of Government of India, which is being facilitated by Ministry of Commerce and Industry. In addition to this, it should also be noted that it operates on commercial lines but with developmental objectives. Thus, its goal is not to be in loss, to facilitate trade promotion, guarantees, etc. But on the same point, the development goals should also be achieved. Means ECGC cannot exclude, eliminate, or disengage with the developmental objectives or goals which are being set by Government of India, Ministry of Trade, etc. in the view that there should be more profits. Thus, profit motive is not the main motive of ECGC, rather, it is the promotion of trade as well as credit guarantees, which means that it has to promote the developmental goals of set by Government of India while also being a profitable venture in terms of its commercial objectives. In addition to it, it is headquartered in Mumbai, where it has regional and branch offices across India, thus facilitating the scope of approach towards exporters by having its headquarters and offices all around India, particularly where critically more requirement is there. Let us now try to focus on the objectives of ECGC. The first objective of ECGC is to encourage Indian exporters to expand and enter new markets because there is risk in new markets, therefore, the exporters may hesitate. Entering new markets, entering risky markets is very important for the diversification of our exports. However, at times it happens that exporters do not diversify just because of the risk which is associated with the new markets. Thus, ECGC tries to promote and motivate exporters and provides assistance to exporters to enter new markets and risky markets. The second objective of ECGC is to provide financial security against the buyer's default as well as political disruptions. Any problem associated to the exporter in terms of payment realization, which is due to buyer's default or political unrest or any type of political disruption, is managed by ECGC by giving some kind of guarantees or securities. This is also a very important objective because if exporter is given certain guarantees or securities for the realization of the payment, which can be termed generally as financial security, then it becomes a very important and motivating factor for the exporter to pursue rigorously exports originating from India. The third objective is that it supports banks in extending pre and post shipment credit to exporters. Providing credit to exporters is very important. Generally, banks and financial institution provides the credit to exporters. It can be pre-shipment credit or post-shipment credit. However, banks also try to see the risk associated with a particular exporters. Thus, in cases where exporters belong to small and medium enterprises, the banks and financial institution may not be ready to provide the credit facility because of the risk involved. Here, the ECGC comes and plays an important role by providing security to the financial institutions, to the banks itself, so that they may extend the credit facilities to small and medium enterprises. Thus, this objective of ECGC is very important and relevant for small and medium enterprises. The fourth objective pertains to it strengthens India's export competitiveness through risk sharing. Export competitiveness improves when a country has more exports, when its exports mechanism is supported by other types of auxiliary bodies, like here we have the case of ECGC. So when exporters and the export environment become facilitated by guarantees, securities, the export competitiveness of any country improves. Another reason for improvement of export competitiveness is the risk sharing mechanism which is being created by ECGC, because ECGC is providing security and support to exporters. At the same time, it is also providing security and support to banks and financial institutions. The fifth objective of ECGC is to facilitate a smooth flow of international trade finance. Trade finance is very important to expand and diversify exports of any country. ECGC, by providing credit facilities, financial security, etc., it is acting as an organization which is facilitating international trade finance. Thus, it creates more opportunities for exporters and for the country itself. Let us now try to delve deep into the functions of ECGC. The first function is the issue of credit insurance covers to exporters. Credit insurance cover is very important for the exporter, because the goods which are being sold on credit to the buyer will be paying after receiving the goods, or as the export contracts says. But always there is some element of credit worthiness of the buyer. Thus, the credit insurance becomes very important, and this function is performed by ECGC. The second function of ECGC, it provides guarantees to banks for export finance. Banks hesitate in providing export finance, particularly to small and medium enterprises. And here ECGC, by providing financial assistance and security to the banks, promotes smooth trade finance for small and medium enterprises. The third function of ECGC is that it oversees credit information reports on foreign buyers. The credit information reports are such reports that talks about the credit worthiness. Credit worthiness is the scale of knowing that whether a particular buyer will be able to default or not, or what has been its history of default. Thus, this credit information reports are very important, because they give the probable and predictable answers about whether the foreign buyer will be defaulting or not. This is also a very important function which is being performed by ECGC. The fourth is market intelligence and advisory for exporters and financial intelligence and financial institutions. So, market intelligence relates to knowing different types of countries, their institutional mechanism, rules and regulations. Market intelligence is also about identifying opportunities in foreign markets, exploring new markets, identifying risk in different markets, etc. Advisory is the advices, the consulting advices which is being given to exporters, that where they should explore more, where they should target, how they can improve the export competitiveness, of their products, etc. All these functions are also performed by ECGC, which provides benefit to exporters of India. The fifth and the last function of ECGC is policy and claim services, where there is extended and recovery support to the exporters, which is part of the insurance credit facility extended by ECGC. Let us now try to understand the nature of risks that are covered by ECGC. The first type of risk is commercial risk, which is being covered by ECGC facilities. The commercial risk involves insolvency or protracted default by the buyer. So, if the buyer becomes insolvent, which means a foreign buyer, or it is not capable of paying the amount due to any other reason, then this will come under commercial risk. Second type is buyer's refusal to accept goods based on any particular reason or argument once the goods have reached to the destination port or destination country. If the buyer is refusing to receive the goods, giving one or the other reason, then it will also fall under commercial risk. And third is failure of bank to honor payment under letter of credit. If the bank of the buyer has not honored the letter of credit due to one or the other reason, due to any lacunas or any suscepticism, then in that case also it will be considered to be a commercial risk. The second type of risk are the political risk, where we all know that the geopolitical scenarios, institutional factors related to governance, etc., may come into play. For example, the war, civil disturbances, import restrictions by the governments, exchange transfer delays, and government intervention in preventing contract performance. All these comes under the political risk. Now, what are the different types of policies that are offered by ECGC for exporters? We have standard policy, which is known as Shipments Comprehensive Risk Policy, which is extended for short-term credit up to 180 days. This policy is widely used because it is the default policy and 180 days are sufficient time for covering the whole credit guarantee. The second type of policy for exporter is the specific policy, which is for a specific type of exports contracts where shipments on deferred payment term or turnkey projects are considered. The third is consignment export policy, wherein the policies are relevant for goods that are sent on consignment basis. The next type is the small exporters policy, which is simplified coverage for MSMEs, that is small and medium enterprise. And the fifth type is the software and services export policy, which covers all the service sector, particularly the IT and consultancy services which are delivered to the foreign countries. Dear students, let us now try to understand each of these policies in detail. The first is the standard policy, wherein we will talk about its scope and features. The first is it covers both commercial and political risk, but for a short-term period. Second, it is applicable for goods shipped on credit not exceeding 180 days. So if the total time is more than 180 days, then this standard or the default policy cannot be extended to the exporters. The third is the maximum cover under this is 90% of loss after deduction of 10%. So whatever loss is there, 90% loss is covered. That is also standard rate. The policy is valid for 2 years, that is 24 months, and it can be renewed on continuation, which is a very easy step, and it also provides smooth functioning for the exporters. And finally, the exporters must report any shipment delays, payments, or default risk associated with the trade facilitation periodically to the ECGC. The second type of policy is the specific policies or special covers. They are for specific projects, deferred payment exports or construction contracts, also known as the turnkey contracts. They are quite popular in certain domains, but they are specific, so their agreements are very important to be noticed carefully. It is tailored coverage for capital goods, turnkey projects, or service contract. So the contract between two parties, that is buyers and sellers, needs to be properly understood to facilitate such kind of policies or covers. These specific policies include the shipment policy, which is short term, as well as buyer policy, which can be medium or long term. Finally, these policies offer higher cover percentage up to 95%. For example, if we compare with the standard policy, in the standard policy 90% of the loss was covered. But here loss can be covered up to 95%, which is more than the standard policy, depending on country or buyer rating. Let us now move on to the next important thing, that is financial guarantees to bank provided by ECGC. ECGC assists commercial banks financial exports through packaging, packing credit guarantee, which is for pre-shipment advances, post-shipment export credit guarantee, which is for bills purchased as well as for discounting of the bills. Third, that is export finance guarantee to cover lending risk for exporters where export finance is involved. The transfer guarantee, where the letter of credit operations are protected through which enhances banks' confidence to lend to the exporters. The next important thing is the buyer's credit and investment insurance. It includes buyer's credit insurance, which covers Indian banks that finance foreign buyers. Similarly, the line of credit guarantee is there, which includes the Exim Bank projects and sovereign lines, that is country to country linkages. The third, overseas investment insurance, which protects Indian investors against any kind of expropriation, war, or transfer restrictions. So, with the help of buyer's credit and investment insurance, Indian companies are motivated to invest and supply abroad with assurance of risk cover. Thus, ECGC plays a very integral role in investment insurance for the exporters. Let us now try to understand the credit rating and buyer evaluation. Credit rating is the rating which indicates the credit worthiness of the buyer. Okay, so each ECGC plays a very important role because it provides the credit rating of buyers. It also provides market intelligence, advisory. So all three things together can be very helpful for exporters, because before going into any exports contract, the exporters can explore the credit worthiness of the buyers. So ECGC maintains database of over 250,000 foreign buyers and 200 countries. So if there's a new exporter who is going with to for finalizing a deal with any foreign country, so the data can help the exporter to decide whether to go with a specific buyer or not. What is the history of the payment of the buyer or the country, etc. So this is very important. Also, each buyer or country is assigned a credit limit and rating, and exporters must obtain specific approval before shipment. Credit limit, that how much credit of goods you can supply to a foreign buyer. It is to save the exporter's interest, because through the data the ECGC can tell that what is the calculated risk and what is going to be a gambling when you are going to sell goods to anybody. So if we consider credit rating, we have to sell exports in line with the credit rating of the buyer. Thus, with the help of ECGC, the continuous monitoring of buyer performance is possible, which ultimately gives early warning signals of default to the ECGC as well as the exporters, which improves the export competitiveness of India as well as reduces the losses to the exporters. Let us now try to understand the premium structure and claim settlement. In the functioning of ECGC, the premiums depend on destination risk, buyer rating, and policy type. So, three things are there: the risk, which is related to a specific country, okay. The second is the rating, which is related again to the country or to the buyer itself, the default risk, and finally the policy, whether it is going to be standard policy or a specific policy. So these three things together are decided and facilitated by the ECGC, and this ultimately tells the what will be the premium which exporter will have to pay. Premiums are paid either quarterly or annually on the shipments, whatever shipments are declared, their valuation based on that. In case of any default or political event, the exporter lodges claim with proof of loss. After that, ECGC verifies cause and extent of loss, and finally claims are approved. Usually the time is between 3 to 6 months and the payment is made. Post payment, ECGC covers dues from buyer or insurance through subrogation. So if we see, the whole setup is to facilitate trade, is to provide much more assistance to exporters to safeguard the interest of the exporters, which can ultimately make our country's export more competitive. Let us now talk about the coverage limits and exclusions by ECGC. So covered, what are the things that are covered under ECGC's insurance? It is non-payment, that is default of the buyer; political restriction, any loss due to political restrictions if the exchange delay, money is not being able to transfer from buyer to the seller because of some issues; bank failure, the defaulting of the bank itself, the foreign bank, etc. Excluded, what is not included in the ECGC credit insurance coverage. Contractual disputes or quality issues are not considered. Deliberate negligence or fraud by exporter is not to be considered. Exchange rate loss not caused by government actions, this means any financial risk is not covered, which means that exchange rate losses due to market functioning, these forces of demand and supply of the market, that is not considered. Then war risk, unless separately insured, if they are specifically mentioned, then they will be included in the ECGC insurance, otherwise they are not. And delay in shipment due to exporter's default is also not to be considered. Let us now talk about the country risk classification. We have talked about the risk associated with buyers, but let us now see the macro risk, that is risk associated with the country. So ECGC categorizes countries from A1 to D, wherein A1 is low risk country, so it is very good, and D is very high risk, where default risk is very high. So this risk is associated with the defaulting of the buyer or the political risk associated with the country itself. It determines the premium rate and credit limit approval by the ECGC for the exporters. Also, these factors which are included are political stability, exchange rate, payment record, debt levels, etc. This country rating system is very important because it supports banks and exporters in selecting market and also devising their strategy to enter the new markets. Let us now talk about role in export promotion and trade facilitation. The role which is being played by ECGC. ECGC encourages exporters to enter non-traditional and emerging markets by assessing the risk which is being associated and trying to minimize those risks for them. It also enables competitive credit terms for buyers abroad because the market intelligence and advisory services of ECGC can be used exclusively by the exporters. It also works with other similar organizations such as DGFT, the Directorate General of Foreign Trade, Reserve Bank of India, and Exim Bank to support the national export policy. ECGC also contributes to India's risk managed export growth and foreign exchange stability. Dear students, let us now try to explore the ECGC's role in export credit ecosystem. ECGC functions as a linking institution among exporters, banks, and policymakers. It works closely with Reserve Bank of India, Exim Bank of India, commercial banks, DGFT, and Ministry of Commerce with different objectives. For example, when it comes to Reserve Bank of India, the objective is to ensure compliance with foreign exchange regulations. With respect to Exim Bank of India, it is the long-term buyer's credit and overseas investment which is the focus. With respect to commercial bank, it is for facilitating the smooth credit and risk cover, and DGFT and Ministry of Commerce to align with the insurance support with trade promotion scheme. All this ecosystem which is being promoted and created by ECGC is very important because it provides critical risk data, country ratings, and recovery support across export finance network. This becomes very important and integral for exporters in India, and it gives boost for our exports to become more competitive in the global markets. Let us now try to identify the relevance of ECGC in the modern trade context. We all know that global trade faces several types of challenges, risks, geopolitical shifts are going on, financial risks are there, payment uncertainties, all these are always associated. But in the modern trade scenario, these have increased a lot. ECGC supports exporters in navigating volatile markets with institutional backing, thus, they can be more confident and more vigilant about the expectation of the default or losses. India's trade ECGC plays a very important role in contemporary times by enhancing India's trade resilience, by expanding coverage to new markets and to MSME exporters, by strengthening bank exporter linkages for credit flow, by aligning India's foreign trade policy and other indigenous policies such as Atma Nirbhar Bharat goals with the export competitiveness of India and other such measures. Dear students, let us now conclude what all we have discussed in today's lecture. We have highlighted that ECGC plays a vital and important role in safeguarding India's export trade against non-payment risk. We have also appreciated that ECGC offers structured coverage for exporters and financing banks. ECGC overall promotes trade confidence and financial discipline in global transactions. Not only this, but ECGC acts as a policy instrument linking risk management with export promotion. Thus, in a nutshell, we can say that mastery of ECGC products is essential for export manager and finance professional so that export competitiveness of our country may be improved and increased. Dear students, thank you very much for being with me in this session.